Legg Mason's Wayne Lin says from a common sense perspective, stocks are looking very attractive right now, but he says it's not the right time to be jumping in with both feet. Wayne oversees all of Legg Mason's asset allocation portfolios with more than $5.2 billion in assets. Joins us in the studio now. So if stocks are looking attractive, well, then why not jump in?
Well, I think you're in a market environment now where there is a lot of uncertainty and there's a lot of sentiment, right? So there's a lot of emotion roiling the markets. And that's really never a great time to kind of jump in because it's very hard to predict emotion, right? I think what we're looking for is a little bit more rationality in the markets, and also the other shoe to drop is if this emotion leads to a real recession or leads to yet another liquidity crisis. So what we're looking at is, LIBOR OIS. We're looking at credit spreads to see if they start to blow out. We're also looking at more sentiment indicators like VIX and put-call equity ratios. The put-call ratios to kind of get a sense as to whether or not this is continuing, right? And what we've found is that you typically, and what the research has shown is you typically see a large spike up in volatility when markets have a big drawdown, but then they slowly kind of come back. And what that says is that it's probably better to wait to see a little bit more stability in the market, and you can catch the upswing then.
Wayne, though, isn't waiting for stability, waiting for rationality to return to the market just going to be too late? By the time that happens, the best opportunities are in the rearview mirror?
I don't agree. I think it's an issue of having a discipline in terms of when you decide to jump back in, and also having a very good sense of what your investment time frame is, right? So if you're sort of a short-term trader, it's a very difficult time right now. But if you're a longer-term valuation-based investor, I would say that right now the valuations, and especially the relative valuations of equities to fixed income, look very attractive, and that building a position over time makes a lot of sense at this point.
I mean, you've maintained your asset allocation right, despite all the turbulence that we've seen in the markets recently, and you overweight on equities, so right, you're taking a little bit more risk than everybody else.
Exactly, I think. But we went into this sort of moderately overweight in the real return fund. We had moderately overweight equities, moderately overweight commodities, because we felt that there was sort of this pro-cyclical story, right, where we felt that we were in sort of a recovery.
How do you feel now? I mean, people want to know, Wayne, where to find real return. If you think we're going to be headed into a recession, the real return may be in treasuries, even though you're effectively paying the government right now to buy treasuries. And equities can't look all that attractive from a real return perspective, can they?
Well, I mean, I think that when we think about real return, we think about returns that adjust with inflation, and treasuries do not adjust with inflation unless you're talking about tips, right? So there is this probability that if you believe that the end game to all of this the government debt around the world, okay, the ballooning of the government debt, one of the end games is potentially more accelerated inflation, and you're seeing a little bit of that in the CPI numbers. But equities provide a real return in that they adjust upwards. Okay, the returns adjust upwards, the dividends adjust upwards, whereas bonds don't.
But do they adjust? But do they adjust upwards fast enough at a time of slowing economic growth and shrinking corporate profits?
Well, I think that here's where you have to focus on the real part, right? You look at whether it depends on whether or not you believe that earnings do adjust and price up for inflation. And if that answer is yes, then yes, you can have sort of a stagflation where you have earnings growing, right? So it's a tricky time, and you really need to do your analysis. But
the fear could keep valuations low?
I'm sorry?
The fear in the markets could keep value.
It very much could. It very much could. But look at it this way, right? Dividend yields on the S&P right around 2.2, 2.25. Treasury yields 2.3. The tax rate for a U.S. investor 15%. Okay, so do the math, right? So that's what we're talking about in terms of relative valuation.
All right, thanks very much.
Good to
talk to you. Wayne Lin, portfolio manager and investment strategist, strategy analyst at Legg Mason Global Asset Allocation.